How's it going, people? Hope you're good. Hope you're good. It's Rodney Leandro here, Mastermind, and I'm bringing you another video about some analysis that I'm looking at. But this video is more specific for my Forex signal group. So I have a free Forex signal group, and this is more so for them. We actually did have some, fire trades that I previously posted. So, people are seeing results, making those profits. We're hitting those TPs, and the strategy and style that I use is institutional trading, and I look at market structure as well. So we're going to cover some things that you need to really understand before taking signals, and then I'll look at some analysis, and I'll post further analysis within the actual signal group as well. So let me just look at the notes that I put on my phone. Right, first things first is always going to be going back to the trading commandments. It's the most important thing when it comes to trading, and it's how you can be consistently profitable and successful when it comes to Forex. And these commandments have been designed by Mark Douglas, and he's somebody who is a successful trader who's worked with many successful traders that were blowing accounts before and losing. And we're talking about 7 to 8 figure traders. And he designed these commandments that work with any strategy and any trader. So it's more about your mindset and values than the actual strategy. And that's anything can happen. It's Forex. We don't know what the banks are thinking, what other retail traders are thinking. We don't know what everyone's thinking, how they're feeling, when they're going to buy, when they're going to sell. Anything can happen. You don't need to know what happens next to make money. There's a random distribution between wins and losses for any variable that defines an edge. Edge meaning your strategy. A strategy on edge is nothing more than an indication of high probability of one thing happening. Every moment in the market is unique. I'm a consistent winner because I objectively identify my edges, my strategy. I predefine the risk I'm willing to let go of that trade. I completely accept the risk I'm willing to let go of that trade. I act on my edges without reservation or hesitation. So it's really about being neutral, being objective, not being scared to take a trade, not being too confident to take a trade and think you know where the market's going to go. Just be objective. Have your stop loss, have your take profit, get the confirmations from your strategy and take the trade. I act on my edges without reservation, hesitation. I pay myself as the market makes money available to me. The market will make opportunities available whenever they hit our stops, our buy stops, or our sell limits, or our market executions that we're actually placing live. We will wait for the TP to be hit or the stop loss to be hit. But those opportunities will arise when we see the confirmations that our strategy needs for us to take a trade. And I understand the absolute necessity of these principles of consistent success, and therefore I will never violate them. I'm trading in sample sizes of 20. That means before you write off a strategy, or before you say, these signals don't work or trading doesn't work, you at least need to take 20 trades and then see if you've been profitable or if there's been a loss, and why. Has it been that you've missed some trades, or what has it actually been? I'm quickly going to touch on risk to reward as well, because risk to reward is probably the most important thing to go with those trading commandments and mindset. Risk to reward allows you to have more losses, but your wins are so big. You have less wins, but the wins are so big that they outweigh the losses and they take out the losses. So in terms of a loss, it's only a loss of profit, but it's not a loss of the actual, balance that you've been trading. And that's how traders become consistent, successful. It's all about their risk to reward. And how you got to see it is the way that a business sees, their liabilities and then their assets that bring them income and makes them profit. So let's say that you had a restaurant. You're going to have to invest money. That's a loss. You're going to have to invest in maybe chairs for people to eat and sit down. You're going to need to invest in the food that they're going to eat, maybe some staff as well, and maybe a building. that's all a cost. That's all a loss. It's a liability. You know, it's taking money out of your pocket. But what's going to bring you profit? It's the customers. And what the businesses aim to do, break even or make a profit. And that's what they're out there to do. Through the customers, they'll make a profit by the product or service they are selling. So I know this ain't a business, but you have to see your trading account like a business, in terms of, if you lose a trade, it was you investing into a liability. And, you know, it's for a bigger reason, a bigger picture. And when you have those wins, it will be like a load of customers coming into your restaurant and buying all the food out, you selling out, you breaking even, or being profitable, being in profit. It's a good way to really see how your trading account will look, and it will take out the fear and the overconfidence. That's really important. So, risk to reward. This is a good example to use, and this is why I use it. So let's say the average profitable trader is winning 3 out of 10 trades, and then they have good risk to reward. You know, they risk 50 pips to catch 400 pips. That risk to reward is 1 to 8. That means that 1 win is equivalent to 8 losses. 1 win is equivalent to 8 losses. So look, they're risking maybe 5 to gain 40, or they're risking 50 to gain 400. And, you know, the difference between the wins and the losses using those stop losses and that take profit is, when we calculate it into money, if we're using a lot size of 0.1, which is £1 per pip, it means that you're making, you know, £850 profit. The losses would have been 350 minus 350 from the profit, which is 1,200. 7 losses, 3 wins. There is strategies that allow you to, you know, have that risk to reward. What I'm doing is looking for one signature trade that will hit this TP, because when you're trading stuff like gold, these TPs in terms of 300 to 400 pips will be hit within the week. I've done it before, you know, several times, and so have other people that I trade with. So I will be sending out 1 to 2 signature trades, especially on gold, because you can hit these pips. And within Forex, in terms of the pairs like GBP, USD, Euro GBP, it will be more risk to reward of 1 to 4, 1 to 5, and it will be a smaller stop loss, so about 20 to 30 pips, and a TP will be around, you know, 120 pips, 150 pips, or 200 pips. But it's still very decent. You know, people within the group have been growing their account by 10 to 15% for the week, and that's what you want to do. That's what businesses aim to do, and consistent profitable traders aim to do. Just grow their account by 10 to 15%, something very, very small. So yeah, any questions anyone has, if you're already in the Signal group, just hit me up on Telegram and I'll answer it. And if you want to know more information about how the signals work, then I'm going to put a link in the description for you to message me on my WhatsApp business number. Right, so look, let me really show you. Look, we're on gold. I'm going to show an example of a trade that would have been crazy risk to reward, and it goes with all the confirmation checklists that we use on the strategy of market structure and institutional trade. So look, we can clearly see gold is bearish, meaning that we're in a downtrend and there's sells. You know, people don't like trend lines sometimes, but look, if we were just to use the trend line, we can clearly see that, you know, price is trending down. So we're looking for big sells. Imagine this on the daily, yeah? Imagine this. We have here liquidity. So let's imagine that we had only seen, you know, this within the market. We was ready in terms of seeing the last up before the down move, the last big buy before the sell, the institutions coming in, the consolidation and liquidity building up. Stop losses would have been here for sells, and this is where trapped money is. So now look, let's imagine that we've marked the open and then we've labeled it maybe daily FU. That means the daily institutional candle. Let's change that color to black. Okay, so yeah, see, with these signals, we give education as well. It's not just about, you know, providing signals. We do give education. All right, let's even highlight this so we can see if there's a better entry that we can get in terms of risk to reward. So we'll highlight that blue. Let's go maybe to the 2 hour. Go to the 2 hour. See what we can see. So we can see right here that there is one up here before the downs, and it's within the area of the daily FU. So let's see what would have happened if we would have used this right here as our entry, and we put the stop losses right here above the highs. Let me just delete that. Let me use this one here, and we'll make it red. We should make this one red for the stop loss. Okay, cool. We'll refresh that, and I will go back to the daily. So look, this is what we're breaking down. This institutional candle just right here. With gold, because the pip count is crazy, you have to use a little bit of a bigger stop loss. So, you know, it's going to be maybe a 40 to 50 pip stop loss. I don't even know what it's going to be, but I'm just saying, generally speaking, that's how it goes. So look, let's just say that, yeah, we're placing this sell. Let me just zoom out. So short position allows you to calculate the risk for a sell. Long position allows you to calculate the risk for a buy. Okay, so look, we're going to enter those coordinates. So the entry price is 1.986.29. Then we have the stop, 1.998.99. I think I might have used the wrong one. Yeah, I was meant to use short, not long, short. All right, so look, we've rewinded it and price was there. We'll just place it here. All right, we'll push this down. We'll just enter the coordinates again, actually, so we can get it accurate. 1.986.29. And then the stop is 1998.99. Boom. Okay. And let's say we was going to target these lows right here. These equal lows that also had liquidity beneath them. Trapped money within the market, liquidity. So buyers would have placed their stop loss within this area. Let's just see what would have happened if we done this. Look, the risk to reward is 1 to 6. We could have even used a smaller stop loss if we, let's see if there was something better in the 30 minutes maybe, because we could have used a smaller stop loss. So let's go back into that area. Okay. So there is this, well, we can bring the stop loss down to this high here. That's what the daily. So yeah, let's say we're leaving it like that, and we'll go to the daily. Let's see if this would have hit and executed. So yeah, we'll leave the stop loss where it is. So you're risking 100 pips to make 700 pips. Let's press play. And then I'll show you what that would have looked like. So did we see that? It hit the entry, went up to about maybe 50% of the stop loss. So yeah, some will say it was a big stop, but look at what we're about to catch. And let's see. Bam, done. We could have even aimed really and truly for, so look, that's 790 pips, or we could have aimed for 1,258 pips. But look, we'll leave it on the 700, yeah, just for argument's sake. Just so you know, in that example on the slide I was showing you, it can be done. Okay, so look, let's say we're using 0.1 lot size, £1 per pip. So that's 1 times 127. So you're risking £127 to make 1 times 790 to make £790. So you can lose that trade 6 times. That's going to be equivalent to 1 win. You know, you're risking 100 to make 700, or nearly 800. You can lose that trade 6 times. That's equivalent to 1 win. So you can really see how one trade can really compound your account on gold, and the examples that we use can happen in the real market. Now let's look at if it was this stop loss. So, I mean, this take profit. So we're risking 127 to now make 1 times 12064. So that's 1,264. Men lie, women lie, numbers don't lie. They don't lie, guys. All right, so we'll take that off now. Quickly speak about what we're looking at. Redo. You know, I'll sort that out later on. Let me quickly speak about what we're looking at now. Is it here? Yeah, okay, it is. And let me exit the replay mode. Okay, so for people in my group, what I will do now is, in case I'm busy, the blue line will be the entry coordinate, so I'll post in the analysis. The red line will be the stop loss, and then this green end of this green box, whichever number is there, that will be the take profit. So just use your head a little bit. If you see that this box is ending here, then it's going to be the number that is beneath this box, because that's going up. So it will be the 1893. So look, not the 1914 or 1907. Yeah, just so that makes sense for you. I'll explain it on another example as well. But yeah, we see that gold is creating lower highs, lower lows. So we're looking for a break of this liquidity right here, for price to come up here, go back to the last up before the down, and then we can get in for a sell 1 to 6. And then there's the lows right here. Liquidity is being built. We have the last down before up, and we're looking for a buy right there. And then we have GBP CAD, which we had a good week on GBP CAD and Euro GBP. We cleaned up. This has an example as well of, you know, a very good trade. I think it was GBP CAD. If I can find it. Was it this? No, I can't remember where it went. Or was it Euro GBP? Oh, this one hasn't hit yet, so we're actually waiting to see if we're going to come back up here or back up to this institutional area. And that's a 1 to 5. I think it might have been on GCAD. Let me refresh. Okay, so look, it was right there. So we can see, look, liquidity, last up before the down, right back up to mitigate. Mitigate means that the banks have pushed price up before going down. So now they're at a loss there. They need to come back there to break even on that order, which they used to push price to that area. So let's say you risk, so look, the open's here. You could have risked 100 pips to make 900 pips. So that's risking £100 to make £900. You know, you can lose that trade 9 times. That's equivalent to 1 win. So yeah, that's the type of signature snipe we'll look for the week. If I see anything on a daily like that, I'll call it out and I'll say signature. But yeah, so we'll go to the 2 hour. We can see that it's creating lower highs, lower lows. So, and there was a lot of buys here. There's imbalance. Price needs to come back down here to fill the imbalance. That's how the algorithms work. So yeah, look out, because if I'm busy, you don't want to miss these trades. Look out for where it will say, so look, the blue line. So this would be a buy limit. It's a limit because price has to come down there to enter it and then go up. This would be a stop because price is up here and it will come down. But I still will post as well, trade alert anyway. But yeah, look, the blue line, if you look at the pictures when I post it, will be the entry, red line, stop loss, the green, TP. So you can see that's the TP for this one. This is the TP for that trade there. Yeah, so this one's coming quite close to entry. GCAD, we're seeing if this institutional candle is going to be respected again or not. It may not, and it might break above and come to this area right here. It looks like this institutional candle has already been played. Look, up before the down, back up to mitigate, and then big drop down. Let's see how much that was. So look, you could have risked 15 pips. So let's say £15 to make yeah, let's just say it was right here, for instance, £90. £15 to make £90. So yeah, man, risk to reward is very, very key. Putting the odds in your favor. So yeah, we'll leave it today. We'll leave it there for today. Didn't want to make it too long. Any questions, hit me up on our WhatsApp business or hit me up on Telegram. I will post my WhatsApp business number in the description. Thank you for your time. And anyone in the group, literally, hit me up. You have my number.